Good day, fellow investors. Google stock is down 45%, while Facebook is down even more, almost 75%. And everybody is killing Facebook, calling it a train wreck, or lost 650 billion, discussing how Metaverse lost already 30 billion of the capex spent, how Mark lost 61% of his wealth. In this video, I want to explain the cyclical versus structural differences between, we'll touch also on Apple, Google, and Facebook that will give you a better understanding of what really matters, and that is the risk and reward of investing now in those specific three businesses, Apple, Google, and Facebook. Then you have to see whatever the media are talking, what is the market's view on Facebook, and then compare it to the price to analyze the risk and reward of investing, which is what we are going to do now. And by the end of the video, you should understand, how the risk and reward of Facebook, Apple, and Google fit you personally. If I can do that at the end of the video, please smash that like button. And of course, we are also going to show our YouTube portfolio, educational portfolio, and see how these companies fit that portfolio at these levels. So we already discussed Facebook when the core topic was that Mark Zuckerberg wouldn't tell us that usage, time spent on the platforms is significantly declining, which disables ad spend, lowers the competition for those ads, and consequently lowers Facebook's revenue and profits. And we have shown how that already impacts profitability down quarter over quarter, and we also discussed how the estimated earnings that impacted that valuation back then were 15, but will likely be 10 or now even lower for 2022. We made a valuation back then discussing the scenarios. What has to happen for Facebook to go to 200 from a stock price perspective, the future growth there, what the market wants to price it, and then also the negative scenario. If earnings go down and the growth rate's just 3% and the market gives it an average terminal multiple, there is still plenty of room for Facebook to go down, still another 30-40% down. Check this video if you want to dig into the details of the valuation. I'll put it in the link in the description below. Now let's go to the current quarter and further train wrecking, as the news likes to call it. So revenue, as people spend less time on Facebook, those platforms are less interesting for advertisers, and that leads to lower and declining revenues. This means that Facebook has likely peaked, and the core factors are that people are spending less time on Facebook and Insta because the peak has passed. TikTok is there, other platforms are there, and YouTube is there. Thank you for watching. Your time spent on your device is limited, so you have to see what you're going to use, and Facebook and Instagram is being used a little bit less. And then also something very important. Whenever you went on Facebook a year ago, 2 years ago, there were all these advertisements that I would get by these crazy guys that promoting search engine optimization, crypto, this and that. All this, a little bit on the marginal side of reality. Now I'm getting normal advertisements. I looked something for Colombia, I have Netflix, so I get HBO Max sponsored, and that is then of course normal. But those crazy guys that used to pop up on Facebook have limited their budget. Likely they are not selling crazy things, NFTs and things like that anymore, and that also impacts Facebook. Plus, on the expense side, all those expenses, general administrative, plus the research and development to develop Metaverse, what Zuck is focused on, is really booming. And for now, the trailing 12 months earnings went down from what the market expected, 15, to the current 10. And if the trend continues, this is very important for valuation, if the trend continues, so we have this decline now of 50%. And if this trend continues for the next 3 quarters, that can easily happen. Facebook's earnings can go down to 5.5 per share from the 15 expected to the current 10.49 to 5.5. So that's a destruction of earnings per share and consequently a destruction in the share price. On top of everything, Mark is pushing his capex spend to develop the metaverse. However, on the positive side, the number of daily users is still there, slowing down a little bit in Europe, stable in the US, but this is again not that relevant. What is most important is the time spent that we don't know, and Facebook won't tell us, but we see in the revenue decline that it is significantly lower, especially as they pushed up their advertisement in the last quarters. Of course, they cannot push it till eternity. And given the high investments, lower profits on higher costs, the cash flows, the free cash flows are now zero. So this is a company that is not modelable anymore. So if you're an analyst, you have no idea what to put in your model, and therefore you have train wreck explanations. Stay away from this. We cannot model it, thus it's not more investable, as people would call it. And that consequently leads to downgrades amid a new reality of higher costs. So they have to explain why they were bullish on it a year, 2 years ago, and now they change their opinion as it is down 75%. In this case, KeyBank and Morgan Stanley move to the sidelines of chaos now that the stock is down. So they don't like changing ratings, but we think that Meta's latest result and forward CapEx guidance are thesis changing and likely to weigh on the shares for some period. Of course, so this is what's going on, so they try to explain it in some way. But it gives you a good perspective on what the market thinks. And KeyBank also, we believe Meta is undergoing a business transformation in a challenging macro privacy and competitive environment and will lead, of course, to lower margins, higher costs, and that will reflect materially worse margins from elevated investment and competition with TikTok and other short-form video platforms. Okay, so now it's not modelable, but this is it. If you look at Amazon's stock price in 2011, at Google's in 2013, at Tesla's in 2013, all those businesses, what they did in the last 10 years was not modelable. And that is what makes investing. And the current price of Facebook that you cannot model from a valuation because there is no more free cash flows makes exactly the investment opportunity and risk and reward that you don't get that often. And the market and everyone is focused on the engagement that will take time well into 2023. Well, that is what is priced in. The market is always myopic, and the key word here is uncertain. If they can't model things with certainty, it is usually a disaster. And when it is a disaster, when others say it is uninvestable, like we said in this China video here a few days ago, then you have to look at how the risk and reward fits you. But let's just quickly touch on Google, that's also 35% down, but still in the business cycle. Facebook has structural issues, Google has normal business cycle issues, growing, and just valuation and the general market sentiment is pushing the stock down. Because if you look at revenues, up 6%, if you adjust for currency, up 11%, still all well. Earnings are a little bit lower because costs and investments are higher, but nothing that much. And the key change in spend is 6 billion increase over the first quarters, 6 billion on sales and marketing, 4 billion, and also cost of revenues, 13 billion. So they are really pushing it, increasing the quality, increasing the spend, and this is just normal. Google earnings per share are a little bit down, so there won't be any growth likely this year, but as they say, they are still investing, working on their other bets on Google Climb, on Waymo, on Wing in Australia, YouTube Shorts, everything, and then they will focus on long-term growth, invest responsibly for the long term, and it is perfectly normal that you will see these fluctuations in earnings. That is then a perfect example of just the business cycle slowing down and then ebbing and flowing, and that's about it. We made a valuation on Google, and of course it can go lower, it can go another 50% down if the growth rates slow down, can happen. But it can also go much higher if they can reach new growth rates. So this looks like now very exuberant with a very high valuation at the end. But let's say that the mid circle, it is fairly priced for a 10% discount rate, for a 10% expected return. When it comes to analysts, and if you want to check what analysts say, I like Seeking Alpha. If you want to read their summaries, just to get an overview on the thesis, you can check my link in the description below and you can get a 60% or something discount on that. Back to Google, the stock is down and analysts have to find something negative. There is no strategic discussion of how they will transition its economics from mobile environments to better align with a structural shift of consumer time forward toward larger screens, blah, 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 blah. But still, they have a 160 share price target rating. So the long-term thesis remains intact, of course, short-term weaknesses, and on the assumptions that advertising demand will continue to weaken into 2023, and the stock will likely follow, and that is the market. But that is again advertisement, the business cycle. Google is still growing, so when that picks up again, Google will then again be the winner. Just a quick comment on Apple. We have bought it for our portfolio in this link. All the links will be in the description below. But nothing new. They made their money, growing 8% per year, so that's in line also with our valuation. And then you have to see how the risk and reward, what is the price to add value. Now, let's put this into a risk and reward perspective. This is something very important. If we look at Facebook, down 75%, the P/E ratio is now 10, but if earnings go down and half again, the P/E ratio will likely go again to 20, and then it will again be normal from a valuation perspective. Alphabet, P/E ratio is 20, the market cap 1.25 trillion, and Apple is still doing fine, growing stable. Analysts love to model that, and the market cap is 2.5 trillion. And the key here is that Apple is easy to model, 2.5 trillion. Google has some headwinds, costs, and everything. And the key is that Meta is not modelable. But look at the differences when it comes to investing. Apple, 2.5 trillion. Google, 1.25 trillion. Metaverse, 266 billion. So 1/10 of Apple, 1/5 of Google. And when it was about Tesla 10 years ago, who modeled factories in Shanghai? Nobody. That's why the stock price did what it did. And we are now in that position, risk and reward for Facebook. I looked at this beautiful video from Marcus Brownlee discussing the potentials and the risk and reward from a technological perspective. I'll put the link in the description below. It's a must watch if you want to understand Metaverse and the risk and rewards of investing in it. Because Zuckerberg, yes, switched to the Metaverse, and that is something, whenever you make changes in life or in your research platform or whatever, people hate it, run away from you, you lose money temporarily, even if it might be for the better good long term. And whether the Metaverse will be something that we will use in the future, that is uncertain. But the biggest chance is that Facebook will be the leader, Metaverse, Zuckerberg with that, because they are dumping the most money into the technology. Nobody is spending 30 billion a year into that. Maybe 300 million, 500 million, but not 30 billion, which gives them scale, power, and just if you look at what they do, where they are already with that technology, when it gets to that turning point that okay, you can now not watch me on this but that, and it's just like a conversation or something like that, then yes, it can be the normally predominant technology in the world, and that is what you are investing now with Facebook. But people are also forgetting about something. They are spending a lot of money on things, but Facebook is still there, Facebook is still making money, Instagram is still being used, WhatsApp is still being used, everyone is still there, a little bit slower, but it's very likely that somehow it will be used over the next 5 years until the metaverse catches up. And if the metaverse catches up on this base and even larger base, if you look at all the platforms there, then it could be really something. And the question now is, how much are you willing to risk? Or are you really risking, as we have discussed in the fundamentals? So that is an approach that is again an investment educational part now, and we are going to imply it in our YouTube portfolio, of course. So here is our little YouTube educational portfolio, and we have now 11 positions. Oh, by the way, I have added this portfolio and structure to our little comprehensive stock market investing course that you can always enroll in for free, where I try to structure the educational lessons that we do here on YouTube. And here is a little bit the curriculum, and I have added here each stock that we have added now, still 9 to go. But if you want to learn more about investing and other educational content, please feel free to do so here below. As said, it is totally free. Back to the portfolio, if I look at the situation here, the worst performer is of course Meta Platforms, and the best one ADM, okay, but Meta Platforms we bought at 158 and now we are at 100. I didn't sell at 180 because I thought that it could go higher. Okay, that was the surprise, but when I'm looking at this, we spent 30,000. As I said, I'm going to 20 businesses in the portfolio, so I can spend a maximum of 50,000, let's say on average, going a little bit more if the opportunity is really there. For that, for Meta and what it is doing and what they already have now versus what they can be in the future, as this is a very diversified 20 position portfolio, I think that from that risk and reward perspective, I can risk a little bit more here, and let's for now add another 20,000 to Meta at the current price, and then over time let's leave for, if it goes to 60, let's leave it for another buy, and then that will be it. And likely over time we're going to do very well here, and if it then explodes and we really start using the metaverse and everything, then it will do even more. Let's buy 201, 203. Sven, Facebook is not at the $300 stock anymore, so let's buy that. So I have placed the order, and when the market opens we'll see if it gets filled or at a different price, or simply buy, and then you will see in the overview what was the right price, of course, when the market opens. So we have put now a big concentration into Meta stock on that long-term investing bet, and you have to see how it fits you. And I wanted to add here an answer whether I would put my money into this personally. And here comes the key question that I think will give you the most value. It is about you. We have explained the risk and reward. There are good fundamentals, there is the basis, there is the usage for Facebook, the metaverse and everything. And then there is the optionality of really exponential returns somewhere down the road, the market hates it, it's not pricing, it's pricing it at a huge negative because Zuck is spending the 40 billion per year. So everyone hates it now. But if you think, okay, this bet, the metaverse bet, fits my investment requirements, it will be something. It might be, it might not be, but okay, I can dedicate that much of my portfolio to this, then it is a great investment now for you. Would I invest personally in Facebook, and whether it is on my contender list that I put some money into? If I just look at myself, no strategy, no obligations, no nothing, it doesn't fit my investment strategy and my requirements for now. So just the company doesn't fit. It can be a 10x easily in the next 10 years, but it can also not be. And given the current situation I am in, it's simply I'm more to the modeling of things, valuation slow and steady, rather than taking these bets. It's not whether it is a bad or good investment, it's just how it fits you. Thanks for watching, I'll see you in the next video.